Good morning, everybody, and welcome to the Passive Trade Stream. Excited to be with everybody this morning. We will go ahead and get started. If you guys can, just let me know in the chat box if you can hear me loud and clear. That would be fantastic. And just again, by way of house cleaning, you're just going to want to make sure that your video is streaming in HD. There should be just a little settings icon in the bottom of your video. You should click on that and go to settings and put that up to 720 HD, and that should make the image nice and clear for you, and then you can maximize your screen. So go ahead and do that if you haven't. If you've got any questions on how to do that, feel free to post those in the chat, and there are plenty that I'm sure we can help you out and make sure that you've got the HD pulled up. So we are going to go ahead and get started this morning. We've had quite the wild ride in the S&P 500 over the past couple of weeks and months as the situation with our Federal Reserve here in the United States grows more and more uncertain as to when they're going to raise rates. It's going to happen at some point in time. We just don't know when. And right now, the global community is kind of hedging, that raise in interest rates, and we're seeing a bit of volatility occur as a result of that. So this is our position that we had on last month. As you can see, Friday afternoon, it was quite the nail biter, but we expired at around 2026, 2025 or so on Friday. This morning, we went down and we tested that 2020 area. Remember, we talked about that in the trade stream for those that were present on Friday afternoon, as we were kind of just keeping an eye on the S&P with that our original short put strike price trigger had gone off. We were keeping a close eye on the S&P, making sure that it was not going to have continued breakdown. But in any case, this morning or on Friday we talked about this market should find some support around that 2020 area, and there was a couple of people that had a question as to, well, why the 2020 area? What caused you to look at the 2020 area, and why is that some support? And the best way I can show you is I'm going to hop over here to the SPY, and I'm going to pull up the volume for this chart, and I'm going to stick a line at about roughly where that 2020 area would be on the S&P 500. So 202 and 20 cents on the SPY. And I'm going to extend that over here just a bit. Okay. So I've got a horizontal line here. Mike B says the trade expired, not us. Yep, you're right. I must have accidentally said we expired. Anyways, so what I'm looking at here is just the large amount of volume that occurred around that 2020 area. As you can see here, that's gonna form a major pivoting area. Right now the price action is trading up above the 2020 area, and so right now the bulls have control of that line. We've had support, or I'm sorry, we resisted on that line here over the past couple of months, and so long as the price action is trading up above 2020, I think that the bulls have control over that line. If that's cracked, then I think that we can probably fairly well expect us to go back down and test the lows of the past couple of months down here around that around 1880-ish area or so. So on or 188 area on the SPY. So anyways, that's kind of what I was looking at there on No kidding, John. Um, that's what I was looking at there on Friday afternoon, and we've gone down and we've tested that area today. That same 2020 area. Um, Again, there's the peak from the 17th of September. That would have provided a lot of resistance, and that's where there was just a lot of volume that popped off. We came into it, consolidated against that area, and then we came down and subsequently supported on that area on the 21st of October. We've also again gone down and touched that area today. The low of the day today was 2019 spot 39. So didn't quite test the low of the day on the 21st. So we'll see. This is kind of a pivotal area. If it does break down here, then really the next level that I would expect us to go down and test is somewhere around that 1995-ish area. So that's just kind of my views on a technical basis. Let's go ahead and take a look here at restructuring this position for the S&P 500. So what we're going to do is we're going to go over to the trade tab. We're going to go up to the second Friday in December options. We've got 25 days remaining in those. We're going to find the options that have around a 90% probability of expiring out of the money or a 10-cent delta. So we'll go ahead and take a look at the 1860s as of right now. So I'm going to go ahead and sell Iron Condor. The way I did that, again, you right click on the either the bid or the ask column. It doesn't really matter. Just right click, sell Iron Condor, and it will go ahead and structure that put side of our trade for us. So we're going to look to sell the 1860s. I'm going to look to buy the 1855s, five strikes, or just one strike price down below our 1860s. So be a $5 wide spread. On the call side, I'm going to take a look at either the 2115s or the 2120s. I'm going to go ahead and look at the 2120s for right now. And I want to make sure that because we're kind of at an area where we can bounce right back up to the highs here, I want to make sure that I am giving myself enough room to allow for a decent amount of a bounce before I would have to adjust. So I've got around 70 cents of premium here. I would expect somewhere around 65 cents at least on this. So let's go take a look at this. I'm going to throw this thing over into our risk profile. And we're going to go ahead and take a look at this on our chart, the 2120s and the 1860s. So let's go ahead and put our short call strike price down here at the 2120s. And let's go ahead and put our short put strike down here at the 1860s. So certainly getting a very lopsided Iron Condor here. It's really favoring more volatility down to the downside. This would expire the second Friday of December, so that's going to be December 11th. Let's go ahead and put that up here right there. All right, now let's go take a look at about where our 70% probabilities will come into play. We're going to be releasing a tool here soon. Really appreciate Robert, one of the members here. He took the time to create a tool that will allow you to easily calculate the 70% probability. We're going to be releasing that with a new version of the analytics tool. Excited to get that out there. But for right now, what we're going to do is we're going to find these options that currently have around a 70% probability or around a 30-cent delta. And we're going to take the difference between that strike price and the short strike that we're selling. So I'm going to take the difference between that 2065 strike and my 2020s. So the difference between 2065 and 2020 here is 45 points. I'm going to go and add 45 points to the current market price of 2025. So 2070 is about where we would have the 70% probability on our short call side. So I'm going to go ahead and move that there to our 2070s. Okay, now let's go and find about where that would occur for our short puts. So we're selling the 1860s, and I'm going to take the difference between 1860 and 1970. So the difference between 1860 and 1970 being 110 points. Let's just confirm that: 1970, 1860, 110 points. If we were to drop by 110 points down to around 1917 or so, roughly, that's about where we would incur a 70% probability, close to it. Okay, we said 1917. Let's go ahead and put that up there. So we've got 1917 there and 1860 as our short put. Okay, so I really don't have a big problem here with the put side of this position. I love that we're getting our short put strike down below these lows of the year this year. That's extremely comforting for me. I'm not quite convinced that we're not going to bounce here, but I'm not one to for the S&P trade to try to outthink the options pricing model. Options are fairly they're very efficient, and right now the market is clearly pricing in more downside than upside movement. So I think that that's something that is easy to really say, well, hang on a minute here. I mean, we were just trading close to that 2120 just a little over a week ago, and am I really comfortable with that? Well, it's difficult to say. Technically, it makes me squirm just a bit, but by way of the options pricing, it's suggesting that we certainly have a little bit more downside coming, and rightfully so, right, John? If we do end up raising rates here, on in the S&P 500, or I'm sorry, if the Federal Reserve ends up raising rates here in December, certainly I think that we could see some downside momentum here in the overall broad market. So I think that I'm going to go ahead and do something along these lines. If I can get the premium that I'm looking for, I certainly would like to bring in a little bit more premium, around 75 cents or so if I could. Let's go ahead and take a look at our risk profile and see what our loss would be if we go up to that 2070 and go down to that 1917 area. We want to make sure that our losses, yeah, it is a big if. So what I'm going to do here is I'm going to put our short strike price on the very ends of this price slice here, so you can see our loss, what our loss would be if we went to our short strike price. I think that's something that's been an interesting thing to look at for some people. What we want to do is we want to make sure that our loss is kept no more than 2 times our expected credit. And so as you can see here on the very wide ends of my price slice, 2120, that is my short call strike. 1860, that is my short put strike. And as you can see, my loss, if it were to go down to my short put strike here, is suggesting that my loss would be a little over 2 times my expected reward. I would expect that to increase just a little bit. But let's go ahead and plug in the 1917 there for our 70% probability on the put side, and 2070 for our 70% probability on the call side. So yeah, it looks like our loss would be right around our expected reward, which is fantastic. Our loss would be about 1x our expected reward. Again, we want to make sure that is no more than 2x. And in this case, it's looking like we would comfortably stay below that, which is to be expected normally. So I'm okay with the potential risk here if we do head up to around a 70% probability on both the call and the put side. I guess what I'm looking at here is, again, I mean, when's the Fed meeting in December? Anybody know? Here, actually, you know what? I'm gonna give you a little sneak peek here of something. Yeah, it's very true. I'm gonna sneak over here to some new real-time quotes that we're going to be introducing here. So here you're going to be able to look at real-time quotes on all of your favorite stocks, in addition to foreign markets. You're going to be able to look up the European markets, the Chinese markets, things like that, and be able to see really global markets with these charts. Not capable of doing that in Thinkorswim. You can do all your technical analysis on this, but what I'm going to look at here is over here on the right-hand side in this calendar little icon. I'm going to go ahead and click on that, and I'm going to collapse November. I'm just going to look here and see when see if I can't find in here when the FOMC is going to be meeting in December, and I don't think I've got it here. Yeah, we're just showing November stuff, so I'm not able to skip to December stuff yet. Awesome, thanks, John. December 16th is the FOMC. So obviously I can't see that here in this calendar anyways. This week, we'll get back to that here in just a moment. So you're saying December 16th, which is after our position expires. So, yeah, thanks, Robert. Awesome. All right. So, yeah, I think the biggest thing here is, does that 2020 hold here, and do we get a little bit of bounce? If we do, I really don't like this short call side of our position, and I'm hesitating just a bit here on you know, with the Federal Reserve not speaking until after our position expires. We could see a little bit of a bounce going into that. We also may see a big sell-off going into that. That's kind of what contributed to this massive sell-off here back in August, was the federal meeting here in September. And then we were able to recover after they did meet and said they were going to keep interest rates at 0, and we've seemed to recover. So I'm okay with the risk here. I'm okay with the premium if we can bring in around 70 cents or so. That's okay by me. Let's go ahead, and I'm just going to highlight here what our losses would be at about that 70% probability for both the call and the put side. And I'm going to go ahead and put this in our notes. Let's go ahead and pull that up. And let's go ahead and take a shot here of the actual position and do that a little bit. Okay, got our price slices in there. Let's go ahead and take a shot here of the actual order. And with our loss, our potential risk here of just one time our expected credit, it makes me a lot more comfortable. If we were significantly greater than that, closer to the 2x area, or at least 1.5 our expected credit, I think I would hesitate a bit more on you know, positioning this thing right now. I'd probably give it a day or so to see if we are going to bounce here this 2020. But with our loss being just 1x our expected credit, I am a lot more comfortable with this position. So let's go ahead and take a look at this thing and put down some notes. So this thing will expire on the 11th of December. We're looking at selling the 2120 calls, looking at buying the 2125 puts or calls. We're looking at selling the 1860 puts and buying the 1855s. And I think that for this particular position, again, I'd be looking for a minimum of 65 cents. I think that that still gives us decent risk to reward. Any less than that, I don't think that it makes a whole lot of sense. Me too, John. I totally agree. Amen to that as well, Robert. So as far as our risk to reward there, that would be around a 16.2% reward return on risk in 25 days. And in this case, we would look to limit our losses to no more than 70 cents, I think. We should be capable of keeping it close to that. As you can see here, our loss on the short call side, if we hit a 70% probability, we would have around a 65, 66 cent loss per contract. If that goes to 70% probability, which would occur around that 2070 price level. Also, we would have around a about a $54 loss, which is the equivalent of 54 cents per contract if our short put strike went to the 70% probability, which would occur around the 1917 price level. I'm certainly a lot. I'm really glad that we're able to get a decent ways below the current market price action for that short put strike price as the uncertainty ratchets up going into this Fed minutes on December 16th. So that is a really good thing. And boy, wouldn't you know, December 16th is right there 2 days before the regular monthly options expiration. So would not be surprised to see a lot of volatility in that week anyways. But tack on Federal minutes, and I'm grateful I'm not going to be in that week for this position. So let's go ahead here and capture this chart and put that in our notes. Okay. Got all that. Okay. So for this particular position, again, we're looking at selling the 2120 calls. Those currently have around a 90% probability of expiring out of the money, and looking at buying the 2125 calls. Looking at selling the 1860 puts and buying the 1855 puts for certainly above 65 cents right now. The mid price is going for about 70 cents. Yeah, I think so, John. I think that would be a responsible thing to do, don't you? Probably wait until that minutes comes out. So once this position expires on December 11th, what we'll probably do here is wait until the minutes come out on Wednesday the 16th, although it will be a really I mean, there should be some nice implied volatility as a result of that minutes just around the corner. I think that it's hard for me to definitively say right now whether or not I would wait, John, for the minutes to come out. I think it would be all based on how far away from the market I could get on my short put strikes around that 90% probability area. Because we should have a lot of a very high implied volatility going into that meeting. So, but I think that if it looks similar to what we have right now, I think that I'd probably wait if we were this close, especially on the short call side. I'd want to be a good ways away on both sides of the action. And if I'm not capable, I'll probably wait for that binary event to pass, which means that we'll probably push structuring our next position until the 21st of December, if that's the case, or at least until the 17th of December, which is Thursday. It's the following day of the federal minutes. But I think that we'll have to probably take a look at where we're able to get our short strike prices at that point in time. So yeah, that's I think so. I think that would be a good idea as well, Robert. I think that's the prudent thing to do as well. Very, very, very true. Very true. Okay, so yeah, right now they're trading at about they're not quite filling at 70 cents. The mid is trading at 70 cents. I think I'd probably hang it out there for a little while, and just let this one kind of simmer there. I know that a couple of people had a difficult time entering into the position last week. I know that it's been said that some people are able to get fills fairly easily, and some people really have a hard time getting a fill on the S&P. I know sometimes splitting up the position has been helpful, and just filling the bear call side and then filling the bull put side. I know you got to be careful because if you don't get filled on both sides, then obviously you're not bringing in the full premium of the iron condor, and your margin requirement will be significantly larger. So the reason for that's a really good question, Ray. Ray says, what is the logic for 2120 at a 0.08 delta versus the 2115? Frankly, I'm just wanting to get away from this action on that call side, because if they don't raise rates, historically we've seen this market bounce. John just suggested, nice, Brett. John just suggested that if they don't raise rates, he'd be a bit concerned because it shows a weak economy. But historically, when they haven't raised rates, now that this has been on the question, it used to be that we were talking about, well, when are they going to stop quantitative easing? Okay, well, the next Fed minutes is going to be, we're anticipating them announcing, okay, we're going to stop easing the economy. We're going to stop pumping new dollars into the economy. Now it's the discussion of, well, when are they going to stop? When are they going to raise rates? And up until this point, whenever they haven't raised rates, the market has bounced on that news as a result of cheap premium, cheap money, and obviously the equity markets are going to be a great place for assets for banks and corporations, so long as money is cheap. But we are starting to get a little bit of currency wars going on between China right now, with them dropping their interest rates as well, or dropping their artificially dropping the devaluating their currency, the yen. So we'll have to see. There's a lot of things going on a global scale that I think that are issues. Not to mention the geopolitical and the international issues that we have going on now with the turmoil over in the Middle East. We'll have to see how that plays out and affects the confidence of shareholders in the stock market alike. Depending on how large of an issue that becomes. It's obviously a heartbreaking issue, and our hearts go out to those people who are suffering right now all around the world as a result of the the terrorist attacks, and it's just a sad situation. So, um, anyways, as far as the logic there, Ray, just really wanting to get up above the current high there on our short strike price. Does it really make that big of a difference between the 21.15s and the 21.20s? Not really. My 70% probability area where I'd get triggered is probably slightly lower, and again, I'm already fairly close here to the action that just occurred, and with us sitting right at 2020, Ray, I'd be actually expecting a little bit of a bounce here. This market so far intraday has proven that it wants to bounce, but the overnight market, it was extremely sold off. In fact, we went down on the on the ESs, the S&P 500 futures contract, the E-mini contract. We went down and tested a low of 1998 spot 50 in the overnight session, and so right now the S&P is currently trading at 2026, and the ESs are trading at about 2022. So right now, I mean, in the overnight session, we were trading. It was looking like it was extremely unbalanced and very light volume, but because that was broken overnight, that chink in the armor is, I would say, a little bit more fluid, to break through this area, because the futures have already proven that they can. And so, frankly, right now, if the S&P were trading, right now we let me just do the math. We tested about 24 points below where we're currently trading on the ESs, and if the S&P were open at the time that the ESs tested that would put us down around 2003, which is well below that 2020 area. And so that puts it down here where my crosshairs are. And so because that was penetrated in the overnight market, despite the low volume, I think that there certainly was a profile that was built there overnight. And what I mean by profile, let me just pull up a 5-minute chart here of the ESs. And when I talk about profile, what I'm talking about here is really just volume that was built. So let me see if I don't have a pre-set study here for this, and I think that I do. So this chart is showing the S&P 500 E-mini contract, and as you can see here, we've got these green horizontal bars that represents the volume that has gone off. That's what we refer to as a volume profile, and the volume profile forms a couple of different significant areas. We've got the volume area high, or the profile high and the profile low. That's where between that horizontal red line right there and that horizontal green line is where about 70% of all of the volume for the day has gone off. It's just tracking the majority of the volume, and you'll find that the volume area high and the volume area low, the bands of that 70% of all the volume today, you'll find that those are areas of intraday resistance and or support. But as you can see here in the overnight hours, so right here, I'm just going to highlight, that is all the aftermarket overnight trading, okay? As you can see, there was a lot of volume that occurred there, and there was actually a large amount of volume that occurred around that 2016 area, which I would say is very, very close to 2020s on the actual SPX. But then we also formed some volume way down here, not a whole lot, but certainly you can see that there was a profile formed down there, and there's certainly action going on down there, but it's not very significant. But I guess my point is here is that because that was penetrated in the overnight session on the ESs, I think that it makes that line in the sand, that 2020 line, a little bit less strong because that has already been penetrated overnight. So, anyways, we'll have to see here what the overall broad market decides to do. If it wants to actually hold that 2020, or if it's going to go ahead and say, see you later, we're going to go ahead and break that. We'll have to find out. But anyways, still trying to get a fill on those for around 70 cents. It looks like a couple of people have. So we'll go ahead and adjourn here, folks. We'll be over in the active trade stream here in another 20 minutes. Going to be introducing to you some new up and coming things that we've been working tirelessly on. Really excited to release those to you and I'll get those features out there on the site. So hope this all made sense. I'll try my best to get all these notes posted prior to the review starting in about 40 minutes. I'm sorry, 20 minutes. But may have to get those up after the stream for the weekly review. Again, we'll be over in the active stream here in about 20 minutes, right at the top of the hour. And if you've got any questions, we'll be here. There'll be a lot of people over here in the stream. Feel free to ask those. And as always, until next time, trade super.